Kenya's second largest mortgage lender, Housing Finance's full-year pre-tax profit jumped 74% to 975 million shillings. Earnings per share rose by 26% to 2.7 shillings. Joining us from Nairobi to unpack the results is the company's managing director, Frank Ireri. Very good afternoon to you, Frank.
Good afternoon to you.
Interest rates quite high in Kenya, yet we're seeing a 74% jump in your 2011 profit. What are people buying on, and why Kenyans this optimism in the real estate market?
We're very happy with the results, and basically been a culmination of a lot of work over the last 5 years within our 2007 to 2011 strategy.
Let's just talk a little bit about those interest rates. Right now, they're sitting around 18%. The central bank has said that some banks are lending at 20%, some at 25%, and there have been plans by Kenyan lawmakers to impose caps on commercial banks and on those interest rates. How could that affect your business going forward?
Yes, the interest rate environment in Kenya has become very challenging, especially in the second half of last year, as the central bank increased the central bank rate from 7% to 18% in December as an effort to fight against the high inflation. We have definitely felt the impact of that, especially in the fourth quarter of last year, where we were forced to increase the existing loans for our customers up to 16.5%. But for new lending from December, we've now been forced to increase it to 23% on the back of the cost of corporate deposits in the market. That will definitely have a negative impact on all lending business in the Kenyan market, at least for the first 6 months of this year.
I want to talk a little bit about the growth rate for Kenya. Last month, Kenya came out and it cut its economic forecast to about 5.3%. Do you think that this is going to have an effect on the real estate market? We have seen in other economies that the real estate market does take quite a knock when there is a downturn in the economy.
Yes, well, the thing again about the property market or the housing market, there is quite a bit of a lag time. And you'll find you have projects on the ground, housing supply projects on the ground that maybe run anywhere between 2 to 2.5 years. Those, at least from our perspective and with our customer base, because we've really tried to mitigate the interest impact on them, will continue. But what we are beginning to see is any new projects being delayed as investors wait to see which way the interest rate regime and also the demand regime is going.
That demand, where are you seeing the interest? In commercial more, in residential? Where are people wanting to buy the most?
Where are people what?
I was asking about the demand. Where are you seeing the demand the most? In residential property or in the commercial space?
Yeah, it's mainly in residential and middle income to lower middle income. So from a Kenya shilling perspective, you're looking at about 8 million shillings and below. There is still a lot of demand for housing in that segment.
Happened recently is Kenya's tourism revenues have risen 32%, and just yesterday we had a story here on CNBC about that KLM and Kenya Airways, they've launched that first freighter service between China and Nairobi, and the KLM person there was saying yesterday that Nairobi now becoming this gateway to the rest of the continent with so many people from outside of Kenya coming to Kenya. Do you think that this could translate to them being attracted to the real estate market in your country?
I think it is going to have a negative impact in the short term, because definitely those interest rates are very high, and for an investor looking for a positive return on investment, borrowing 20% plus becomes very difficult. But what you find, and we are also working on this, is looking for alternative sources of funding, especially offshore and longer term, to help cushion against these short-term shocks.